Good morning, I'm Robert Tan. Join us as we follow the money from the financial choices that shape your daily life to the bigger forces driving the economy. The headlines. Diesel down, gasoline up. Mixed fuel price movements are expected next week. The United States and Iran exchange fire again despite the ceasefire and as Iran reviews a U.S. proposal to end the war. And when you invest, how to stay calm when markets become volatile. Marvin Fausto, President and CIO of Call Strategic Growth Fund, joins us. We begin with a fuel price watch. The Department of Energy says diesel prices could drop by up to 9 pesos per liter and for kerosene, 12 pesos. Meanwhile, gasoline prices may increase by up to 1 peso and 70 centavos. In a radio interview, DOE Oil Management Bureau Director Rino Abad says global oil prices are moving closer towards normal market-based levels before the Middle East crisis began. The United States and Iran trade shots again despite an existing ceasefire and as Tehran reviews Washington's proposal to end the war. Iran's military said the U.S. targeted 2 ships entering the Strait of Hormuz and carried out strikes on Iranian territory. Iran called this a violation of the ceasefire, but the U.S. says it was only acting in self-defense. And despite the new attacks, U.S. President Donald Trump notes that the ceasefire remains in place. He says negotiations are ongoing.
The talks are going very well, but they have to understand if it doesn't get signed, they're going to have a lot of pain. They want to sign it, I will tell you. They want to sign it a lot more than I do.
On the corporate front, DMCI Holdings Incorporated ended the first quarter with lower earnings. Net income fell by 2% to 4.9 billion pesos. However, the company says stronger contributions from its real estate, nickel mining, off-grid power, and cement businesses largely offset weaker results from its integrated energy segment, as well as lower effective contribution from Maynilad. The MCI also declared 4 billion pesos in cash dividends today. Metro Pacific Investments reported higher core profit. Core net income rose 5% to 6.9 billion pesos in the first quarter. Resilient demand for essential services lifted earnings amid high energy costs and global volatility. And Petron Corporation passes the torch to Ramon Ang's son, John Paul. He has been appointed president and chief operating officer of the country's largest oil company. Ramon Ang, who was Petron president since 2015, remains as chairman and CEO. Coming up, buy, sell, or hold in uncertain conditions, how to position your next move. We bring in President and Chief Investment Officer of Call Investment Management, Marvin Fausto, next. Welcome back. Every investor faces the same 4 decisions: buy, sell, hold, wait. What separates the ones who get it right consistently across cycles and crises isn't luck, but a playbook that helps you cut through the noise. And joining us this morning is Marvin Fausto, who runs the Call Strategic Growth Fund. He's managed money through rate hikes, currency shocks, political upheaval, and global crashes. Good morning, Marvin. Welcome to Follow the Money.
Good morning. Thank you for having me.
Thank you for joining us this morning. Now, Marvin, walk us through how you actually make decisions when a market signal crosses your desk. Inflation, a rate move, a GDP print. What's the first question you ask yourself?
The first question I ask myself is what has changed in the assumptions that we made earlier during the year. As you know, during the year, things were a lot different. We were expecting interest rates to go down.
Yes.
Inflation stable. GDP probably will improve. And we were up 10% in the stock market, right, as of February. And things suddenly just blew up.
Yeah.
So, and interest rates now BSP increased interest rates, inflation's up,
Yes.
GDP's down. So things have changed. What adjustments do you need to make now? The
Yes.
assumptions that you made before has changed. So we have to now look at the risk return metrics, look at the different valuation methods and adjust accordingly, and then rebalance accordingly your portfolio depending on the objectives of whatever fund you're handling.
Now, with everything that's happening, Marvin, what does a genuine buying opportunity look like to you today? Not on paper, but in practice. What is to be true before you actually move?
While the numbers can speak for itself, we have to look at the whole picture. We have to look at the different type of valuation now. It's not just about PE. It's not just about what the numbers are telling you. We have to adjust according to. We have our own proprietary way of valuation things. We call it FTSR. The fundamental. We combine things like fundamental, technical, sentiment, and risk. And when we put that all together, we come up with a certain value. When the value gives us a bigger opportunity, and more particularly, for example, sentiment. Sentiment is a big thing.
Yes.
If the war in Iraq, in Iran stops and Hormuz is open, sentiment can change overnight, and that's going to change the whole picture. So we have to understand that right now. The sentiment is really bad, and things are just happening and adjusting as we go through this now. So buying opportunity will come when all of these things are aligned. I mean, these measures that we have comes aligned, and then we can move.
Now, when we look at actions being made not only by government but also those investors that you have discussions with, when we talk about holding, it's the hardest decision because it looks like you're doing nothing. How do you know the difference between conviction and complacency when we're talking about right now, just holding or not doing anything?
Yeah. Complacency sets in if your personal biases are overpower whatever is critical strategic thinking. In other words, if you have your own biases, like for example, you are too close to the market, you have your own analysis, you stuck to it, you are not subject to these changes, and you already spent a lot of time analyzing, you have what you call the endowment effect or confirmation biases. All of these things, we are human and we are affected emotionally, and these things come into play. If that overpowers whatever numbers is facing you, whatever the reality is, then you become complacent. Then you stop thinking strategically, and the conviction now just stays, and things can just go wrong.
Sometimes it's hard to balance which way you're going to move. But when we look at the data that's coming out as well, and what we're waiting for also is what the BSP is going to do, since today's inflation is at 7.2%. GDP has slowed down to 2.8%. The BSP at 4.5%. The last time we had this discussion, you were saying they shouldn't have actually raised it, but it happened. But I want to ask you on that point also now, since from 4.1 inflation rate to 7.2, what do you think is going to happen?
I think things are just going to get worse. An inflation jump from 4 to 7 is not, inflation doesn't move in a volatile manner. It trends. In other words, if it goes to 4 to 7, it doesn't go back to 4 next month.
Yes.
It trends up, and that trend is very hard to stop. So we are just in the start of that trend. And as the trend moves in, this now, the secondary effects of high oil prices, high transport costs, now will feed into the other input costs of different companies. And that now feeds into the margin, feeds into the demand, and feeds in other things. So things are just going to get worse first before things can get better.
But in the situation that we're in right now, Marvin, what can happen? What do you think in the moment where your playbook says wait? But what does waiting actually look like inside the fund when you talk to your investors?
Waiting is just like you get stuck. No, I mean you get stuck on you freeze. And that's a normal thing to do it because you get shocked about things. I got surprised with the rate hike to BSP. I thought they shouldn't have increased rates, but they did because probably they saw a lot more data than I did, and probably they're in a better position to say the expectations on inflation is going to be higher, so better to hike rates now. That's their job. So these things happen, and we need to now look at the situation. You cannot just hold and wait. There's the time to rebalance. For example, if you interest rates are inflation going up, interest rates are going up. Your long-term investments in fixed income will be hit. The market value of our fixed income is going to be hit. Interest rates go up, your bond value goes down. So time for you to rebalance the portfolio depending on the risk appetite, depending on the objective of your customer, of the mandate in the fund. If the mandate is to manage risk and return depending on how the volatility of the interest rates come out, then you have to rebalance. And then also on the stock market, on your portfolio, you have to look at the whole picture and see, rebalance where the risks now are increased and adjust it accordingly, depending on the objective of fund. So it really depends on where you are, the risk appetite of the customer. But when you look at the portfolio and things change, as it did now, meaning GDP down, inflation up, we are looking at probably stagflation, and things are just going to move differently.
But in our current
and your portfolio have to be adjusted. Yes.
But in our current situation, Marvin, how much can fiscal or monetary policy help?
Monetary policy probably not as much, but fiscal is the one that's really have to drive this thing. We have seen in the past quarter that the fiscal spending has been low. Investments have been low, more particularly from the government, simply because of the problem that we had in the flood control. They're doing things, they haven't been spending much on infrastructure. That fiscal has to move and has to move fast. And there's not so much that the monetary policy can do. It can only manage demand, not supply. So this is a supply shock issue. This is the supply problem. So supply has to be addressed. Now, the government, of course, we're expecting them to push now with the infrastructure, more particularly flood control, because a couple of months from today, July, it's going to rain. It's going to rain. And if you haven't done anything on the flood control, that's
another crisis waiting to happen.
That thing is going to flood again. And it's going to affect everybody again, right? So, I don't know. They have to act fast, and we have yet to see fiscal side moving.
Now, for those watching us, investors, seasoned investors, new investors, and also those investors that you have discussions with during this time of crisis that we're experiencing, what does a value trap look like before it springs? Now, how do you identify the investments that look right on the surface but aren't? What kind of research do you do? When you dig deep to your playbook, where does that come in?
Value trap is exactly that. It's a trap. The value trap comes in if you use history to predict the future. It's like you rely on history too much to predict what's going to happen. For example, PE. PE is low. I mean, relative to history. Now you use that to kind of an idea that PE using out like 9 times PE relative to the history of the stock exchange is about 15 or 16 times. You use that as a basis. Oh, you can probably go to 16. It's not. That's a value trap. You are actually using, as an analogy, you're looking probably a rear view mirror in driving. You're looking at the rear view mirror to use as a direction when you're driving, and that's going to be a problem. But things will change. You have to adjust according to how things are changing in the future, not basing it solely on the past. You will be trapped with that kind of analysis. It's not going to be PE anymore. It's not going to be discounted cash flow anymore. It has to be a different kind of valuation that you have to put into the market right now, because the market has changed. It's not like before anymore that at an 8 times, 9 times PE is cheap. It doesn't necessarily mean it is cheap, right? It depends on how future is going to change. how the future is going to affect the company. For all you know, 8 times, it can go to 8 times or 6 times. It depends on how things are going to move forward. We cannot be trapped on how things have been in the past. We have to change how we look at things in the future.
And when the currency weakens and inflation is running at 7.2%, how does that change the way you read consumer-facing businesses? Where does the pressure show up first?
Pressure shows up in the input costs, in increases in the input cost, particularly raw material, transport costs, insurance costs. That's going to come up first in that area, and then it will feed into the margins of the companies. Now, whether they will pass that on to the consumers or take it up themselves, it depends on their strategy. But if they pass it on to consumers, demand will be affected. So for consumer-facing companies, it's going to be tough. Now, the more resilient ones, the more the companies that are more what you call has a moat or a very critical supplier of consumer products, then you're talking about power, you're talking about services that are very basic. They can surpass this. But the other consumer-facing companies will have a very tough time for the coming months.
Now, as you look at the different variables, Marvin, from investor sentiment, the data that you're getting, the research that you're seeing, the signals, the movements in the markets, from your standpoint, what is the market getting wrong or right at this moment? Where's the mispricing that most people are either missing or too cautious to act on?
I think some of them have already been priced, but I mean, to a large extent, I think they haven't priced in much of the downgrades. I still see earnings forecast of a high single digit in terms of the company, the stock exchange. I have yet to see adjustments on that on a consensus basis. I think what's happening now, low GDP, high inflation, low fiscal spending, and a lot of these issues still, oil price still high. Companies will have to adjust earnings, and the banks more particularly are increasing the provisionings. So this will affect the earnings, and I believe market hasn't priced that yet as much as it should have. So I see some downgrades coming in still, and that will have to be priced in the market. The second round effects is another thing. Interest rates, high interest rates, will feed into the cost of companies' interest expense, and that will now feed into how they price their consumer products, how they price their products and services. That has to be priced in as well for the coming months.
Now, as you manage your funds, as everything that's happening is quite fast right now, how fast are you adjusting? How fast are you adapting? Has your strategy changed in the past couple of weeks in terms of how you look at where to invest? Yesterday, I was talking to a financial advisor, and she was saying that a lot of people are now looking at global ETFs. The local market is not really that good right now, but if you look at the local markets, where is the opportunity that we haven't seen yet?
In the local market, opportunity is in fixed income right now. It's in fixed income because we see 7% on the 10-year bonds, 7% higher. That is a very good opportunity for companies to go invest in fixed income. And that if the economy weakens further and we go into a recession or a stagflation, and the move later on, not yet today, in a couple of quarters, but moving forward, we will see the government of the BSP cutting rates and just to spur the economy, because the economy is going to be weakened, and then the only way to spur activity is to bring down interest rates. So rates that you're getting now is very opportunistic, meaning you have a very good opportunity to get yield. You get a good yield of 7%, and then the capital appreciation can come in next year. Now, on the stock market, that's quite difficult. We still have to see some resilience. We have to look more actively or more selectively on ones that can go through this as a winner, meaning they can pass on the cost, they can continue growing, and those stocks, very selective, is going to give you the return you can get. Now, you're talking about foreign. That opportunity is here right now. We in COL, we have funds that can allow you to buy foreign investments, even in pesos. Before,
as a way to diversify.
Yes, that wasn't available before. We have democratized investing in the stock market, and now we have democratized investing in foreign investments by way of what you call feeder funds. You put in all together a lot of these feeder funds. In pesos, you can buy in pesos a very low amount, sometimes some are 1,000 pesos. You can buy a fund that feeds into the S&P 500, feeds into the all-country world index, feeds into China, feeds into
well, at least it's good to know that there are options that we can do in terms of investing. But finally, Marvin, after everything this market has been through, what has fundamentally changed about how you follow the money?
Yeah, following the money now is very critical to understand the landscape. The landscape has changed. Global investing is apparent here and now. You can do it now. That's why we tell our customers, we tell our investors to diversify a portfolio, not just local, but also in global investing. But look at it as a total. And do not forget, of course, the Philippines. Philippines, do not forget investing a strategic investment in the Philippines, but on a strategic, on a selective basis. And then diversify into bonds and global equities, and moving to ones that can give you a holistic and a more diversified exposure. We do that. We guide the customers, we guide the investors on how that is done and navigating this new market or these new global markets. But for those who are beginning, just try it out a bit, understand the way to diversify outside. That's the fundamental change right now. Before,
well, I guess that's the playbook right now.
Yeah, you cannot access foreign investments before. You have to have 25 million pesos. You have to have $1 million before you can do that.
That's good. Yes, that's good to hear, Marvin. On that note, thank you very much for joining us this morning. Always great to hear your insights, and of course, great to see that there's other opportunities and that we can have in terms of investing.
Thank you very much for having me. Morning.
Okay, and that's all for today. I'm Robert Tan. Every day we'll help you make sense of the financial choices and economic forces that shape everyday life. Thank you for watching. Keep it here on the Bilyonaryo News Channel, and always follow the money.